Alright, in this video we're going to look at two cases. The first case, we're going to recalculate the weighted average cost of capital for the Marcus Corporation using 70% equity and 30% debt. In a previous video we calculated the weighted average cost of capital for Marcus Corporation, but that was with their existing capital structure of 59.17% equity and 40.83% debt. So we're going to change that. We're going to use the capital asset pricing model because it allows us to change the cost of equity based on the debt to equity ratio of the firm. In order to do that, we have to start off by recalculating the beta for Marcus and unlevering that beta and calculating the asset beta. In order to do that, we rearrange the Hamada equation. So that's the Hamada. And we say that we want to calculate an unlevered beta, or the asset beta, which would be equal to the equity beta of the firm as it stands, divided by 1 plus 1 minus the existing tax rate, multiplied by the amount of debt divided by the amount of equity in the capital structure, or the debt to equity ratio. And that gives us an asset beta of 0.99. Now what we want to do is relever that beta using the new debt to equity ratio of, or a debt ratio of 30%. In order to do that, we take the asset beta and multiply it by 1 plus 1 minus the tax rate. Again, we're going to use the 38% multiplied by the new debt to equity ratio, which would be 0.3 divided by 0.7. Please note that I'm not using the debt ratio but the debt to equity ratio here. You'll get a very different number using the other amount. So we get a relevered beta of 1.26. Our new cost of equity then would be, using the capital asset pricing model, would be the risk-free rate of 4.6% plus the new relevered beta multiplied by the cost of equity using the capital asset pricing, or excuse me, the market risk premium, or 11.46%. The after-tax cost is now, the pre-tax cost of debt is now 7%, which is an increase from 6.3% because we are using a higher amount of debt. So the after-tax cost of debt would be equal to 0.07 multiplied by 1 minus the tax rate of 0.38, or 4.34%. And the weighted average cost of capital would be our cost of equity multiplied by our weight of equity in the capital structure is 0.7, and I get that right here, 70% equity and 30% debt, plus the after-tax cost of debt multiplied by the weight of debt in the capital structure, or 0.3, and we get a weighted average cost of capital of 9.32%. Now I want to point out what happened to the beta for the firm when we decrease the amount of debt in the capital structure. It went from 1.42 to 1.26, and we should expect that to happen because with less debt, the firm is less sensitive to changes in interest rates and in changes to the economy because they don't have that fixed debt payment to make anymore, or as much of a fixed debt payment to make as they did. So they're less sensitive to changes in the economy. The asset beta should always be less than any levered beta because this is the beta if the firm has no debt. Okay. As a result of changing the capital structure, in this case, the weighted average cost of capital as calculated by the capital asset pricing model actually increased to 9.32%, and that's because the cost of debt, even though it went up, the cost of debt is still lower, especially the after-tax cost of debt, is still lower than the cost of equity. So what that results in many times is, as we reduce the amount of debt and increase the amount of equity, the weighted average cost of capital can actually increase. The second case is that we're going to look at is calculating the weighted average cost of capital for one segment of Marcus Corporation. Now, Marcus Corporation is in the business of movie cinemas or movie theaters and hotels. And if we're going to look at a project for the cinemas, we need to calculate a separate weighted average cost of capital than the overall cost of capital for the firm. Just like before, we're going to use the capital asset pricing model. Although it may not be the best model to look at, we can use it in this case because we have the betas for two competitors that operate only in the cinema segment. And we know that what their capital structure looks like, so we can unlever those betas. We can relever the betas to based on the capital structure of Marcus to figure out what Marcus's cost of equity would be for the cinema segment specifically. Now we have two different companies. One is Regal Entertainment, one is Carmike Cinemas. Again, they are almost entirely operating in the cinemas business or the theater business. They're very different in terms of size. Carmike has a market cap of $496 million compared to Regal's market cap of $3.41 billion, so very different in terms of total amount or total capital. The total capital for Regal is $5.34 billion compared to the total capital for Carmike Cinema at $750 million. So you might keep that in mind. The total capital for Marcus is $674 million. So in terms of size, it's actually slightly the total company for Marcus is a little bit smaller than Carmike Cinemas. So if we look at Regal Entertainment, the first thing we want to do is unlever their beta. So what we're going to do is take their equity beta, and again, rearranging the Hamada equation, we're going to take their equity beta and divide it by 1 plus 1 minus the tax rate of 38.6% multiplied by their debt to equity. In this case, we can take the total value of their debt, $1.93 billion, divided by the total market cap of $3.41 billion. And there's no reason to make it into billions. The ratio would still be the same. So the asset beta for Regal Entertainment would be 0.75. All right, moving on to Carmike Cinemas. We first start off again by calculating the asset beta, and we do that by rearranging the Hamada equation and dividing the equity beta by 1 plus 1 minus the tax rate, and then multiplying that by the debt to equity ratio. Again, we don't have to put it in millions. We can just take the $254 million in debt and divided that by 496, and that gives us an asset beta of 1.78. So you see we have a pretty big difference between the two. Something to consider here is which one more closely reflects the risk of Marcus. So Carmike is a much smaller cinema company, but still in terms of the size of the cinema business that they're engaged in is larger than Marcus. So the size of the company may have an impact on that market risk. So that's something we want to take a look at with Marcus. For now, I'm going to look at just the average asset beta between the two. And I get an average, oh, that's not right. I get an average asset beta of 1.27. One thing to think about is, this sound reasonable for the company? Marcus has calculated up here an asset beta of 0.99, so we'd want to maybe think about the hotel division and what their beta would look like. But for now, we'll go ahead and use this asset beta. So what we're saying is that the assets of the cinema business are a little bit riskier than the assets of the hotel business. So we're going to relever this beta by taking the asset beta and multiplying it by 1 plus 1 minus Marcus's tax rate. And I'm going to go back up to the top up here, and their tax rate currently is 38%, and multiply that by their current debt to equity, which would be 0.4083 divided by 5917. And if you want to, you could also use the amount of interest-bearing debt to the market cap. It's the same proportion, so it doesn't matter which one you use there. And that gives us a relevered beta for the cinema segment of their business of 1.81. Their cost of equity would then be the current risk-free rate plus the market risk premium multiplied by the relevered beta, or 14.44%, and a weighted average cost of capital is 14.44% multiplied by the weight of equity currently in their capital structure, 59.17%, plus the after-tax cost of debt that we calculated in a previous video of 3.91% multiplied by the weight of debt in their capital structure, or a weighted average cost of capital for their cinema segment of 10.14%. One important thing to point out, though, is that you really do want to find the closest match. Maybe they have 2 or 3 close matches. Taking the average of those would be fine. In this case, I would suspect that Carmike is probably the closer match for the company. So if I wanted to, I could reevaluate this. Instead of putting the average in there, I just use Carmike's asset beta for the calculation. That would increase the weighted average cost of capital for the cinema division to 12.51%. So I just put in Carmike's asset beta there. I hope this has been informative for you. Please let me know if you have any questions.